Sandeep Tandon joins us. Let's take our conversation forward. Sandeep, good morning. Thank you for joining us. Let's start with a very basic question, Sandeep. What is your assessment of the market? Because there are two big moving parts now. One which came from Fed last night and one which came on the COVID front last week.
So let me start with the, because a lot of market participants are worried whether we have seen the top of the cycle, and market down. I just want to take you back for a minute. Let's understand what happened in March 2020 and where we stand now. And so it will give you a better perspective in the larger markets angle, So if you recollect, like March 2020, something similar fear was there. Obviously, the intensity of fear in March 2020 was significantly high. By the way, today also, the India Fear Index, the Quant Fear Index, is second largest spike we have seen after 2020. Okay, so when 2020 unfolded, the risk appetite collapsed and liquidity was extraordinary, which was a lethal combination for a bull run, and we have seen for nearly 18 months of massive spike. Now let's understand where are we right now. Okay, from a global perspective, the money flow towards global equity in the month of September was multi-decades high, and since then it started drifting down a bit. Okay, second most important thing, the global liquidity still remain reasonably large, still ample liquidity is there, but in terms of percentage change, it started drifting down a bit. Okay, third important thing in terms of risk appetite. The risk appetite is also drifting down, particularly developed market risk appetite is slightly declining, but it has not collapsed significantly, then one should be too much worried about. Okay. Now, if I have to really combine, and we can say that we are in euphoric phase globally. Okay. Now, if you ask me, can this euphoria can last for a few more months? Answer could be yes. Maybe it's after a small correction or consolidation, which we are seeing, it can still move up. But if I have to look at when I'm one side, I'm saying it's a euphoric phase. If I dissect the euphoria between the component of growth and value for MSCI World or FTSE World, okay, then which is very interesting data which comes out. The quant perception analytics or the indicators have actually peaked out of seeing a euphoric sign for the growth stocks globally. Okay, and the value stocks are actually on the lower end. Okay, so it's very clear that we have seen euphoria in growth stock and not the euphoria in general. So it's not be fair to say that the global market has peaked out. Yes, we are in euphoric space for global market. And if I have to conclude another important data point from that, from the liquidity perspective and money flow perspective and risk appetite, we can easily conclude that the easy phase of bull run is over. Okay, the bull run which we have seen, which is very easy month on month and week on week, people used to make money, that phase is definitely over. Okay, but we are still in a bull run. We are in difficult phase of bull run, but we are still in bull run. Okay, from the current context, let's look at. Okay, we have been slightly cautious for last 2 months or so. We have been talking about the VIX cycle inching up. Okay, so if I have to really look at the current data from a global perspective as well, India perspective, the India Fear Index is second highest after 2020. In terms of liquidity, India good liquidity is still rising. Risk appetite data point on relative basis better than global markets. Yes, it is towards the upper end and marginal drift we have seen, but largely constructive. So if I have to really conclude from multiple data points, have we seen a top of the market in India from a longer term perspective? Answer is clearly no. Okay, the upside is still pending. We have not seen any classic signs of euphoria which is required. Yes, we have seen euphoria in a small cap. We have seen euphoria in certain growth stock. We have seen euphoria in certain pockets. Okay, but that does not mean that we have seen a euphoric move in the Indian market as a whole. Okay, so we remain very constructive for Indian equities from next few years perspective. I don't think.
Right. Okay. So Sandeep, just to break the point for our viewers, because we've covered a lot of points. You are of the view that the bull market is not over. You are of the view, based on your proprietary indicators, that even though it's been a 10% fall only, the indicators are saying that technically we are nearing a near-term trading bottom as well. And you are of the view that there is euphoria, but the euphoria is there in some of the growth stocks like internet companies or IT companies or some of the global so-called startup companies. Great point. So now let's take the conversation forward. Divide the market in three parts for us based on your understanding and your technical plus fundamental indicators. Stocks which you would like to buy in this decline. Stocks you would say, look, I will not buy them, but I will hold them. And stocks you would say, I would sell them.
Okay. So we don't want to talk about stock specific thing, but we can definitely talk about broader sector. So when we look at the first component we talked about, that obviously we will like to look at the value value portfolio. The weightage of the value portfolio should be significantly higher on the higher side. That's the first point. The sectoral themes which we like, despite we have seen a very massive correction happen in the banking space very recently, we like banking from the current level. So banking, capital goods, maybe media, textile, okay. And some of these names are still looking good to us. And we believe that India capex cycle has just started. The capex cycle typically are slightly long lasting. It lasts for 8-12 years perspective, and derivative of capital of the capex cycles are much more. So we remain very constructive on the overall capex cycle. So if you look at if I have to talk about the larger theme of value, then emerging market are also considered as a value relative to developed market. So I think the area should be value stocks. The way you define values, one can look into it, but the skewed towards value rather than the growth from the current levels.
Good morning. So you seem to prefer the value stocks at the moment. You've particularly talked about banking as well as textiles. What about infrastructure? Because, as sovereigns start pump priming the economy, we are seeing budgets only go up. What about that? Or even for that matter, like, power and all of that?
So we remain when we're talking about capex and a capex cycle, then infra is part of it. Power stocks are also part of it. So we remain equally constructive for infra in general and power and energy stocks in general. Very, very constructive on both the spaces. Another point also you look at when you talked about, monetary stimulus as an exercise has collapsed or failed miserably in last many years. Okay, now the fiscal stimulus cycle has started. The US is another example which is going to happen. And whenever you see fiscal stimulus happening, the infrastructure spending actually moves up. And given the interest which we have seen in the commodities market is also indication that capex cycle is coming back, not only India, globally.
What about, what was your view as far as IT goes? That we've seen a big run up in valuation. And the reason I'm asking you this is the last time round when we had uncertainty, when it again became the norms as far as travel restrictions go, a COVID variant, etc., IT had become a preferred pack. But now you have seen valuations really run up. And this time it doesn't seem to be the flavor of the season, thanks to how expensive it's become.
See, the way we look at we believe that, market never penalize or react in the same manner for the crisis which we have seen in 2020. We talked about second wave of COVID, the impact was slightly lower. And now we're talking about third, maybe expected bigger wave. I don't see anything happening on that front because if I have to look at our perception indicator for technology stocks globally, they are trading actually on the lifetime highs. And when I say perception indicators are peaking out, what it means, we are not trying to say that their price has peaked out or their earnings has peaked out. What we are only trying to say, the valuation multiple of this sector is actually peaked out. Okay, and market obviously when earnings expand and PE expansion happen, that's the time you made maximum money. I think one important factor of PE expansion or the multiple expansion has started declining. I think we believe that valuation multiple for this stock or this sector has peaked out. Hence, we are remaining very cautious. I'm not negative. I think the outperformance phase which we have seen in IT in last many quarters has actually peaked out. So we remain very constructive on this space from a longer term perspective. Answer is yes, but I think the outperformance has gone. There will be a market performer now.
Interesting. Within the defensive pool, Sandeep, I also want to throw in pharma here. Would you say the same about pharma as well? That the easy, low-hanging fruit money to be made is behind us? Or would you say now with this Omicron variant, and God forbid, I hope it doesn't spread, the the way the first variant did, or we don't see another wave of the variant spreading coming in, do you think the prospects of pharma now change? And also to add to that, where is it that you then stand on the entire debate about how to treat beta versus defensives?
So when we're talking about, let's say, pharma as a sector from our quant perception analytics point of view, it actually peaked out in March 2015, and then it actually bottomed out in September 2009. Now, if I look at from the current level, yes, we have seen spikes and then small correction happening in the pharma. Like technology stock, when we say the perception analytics is peaking out, there is no sign for such thing happening in the pharma space. Okay. Yes, easy phase has been played out. If you have to ask me from March, let's say September 2019 or to October 2020, one round has played out and we have seen a correction and consolidation happening. We remain quite constructive on the pharma space from a longer term perspective. I think buy on dips strategies should be very effective. And I think the second up move is irrespective of this COVID move. Okay. Sometimes, cycles are about to change and then some event unfolds and it just acts as a trigger. Okay. So similarly, when market was significantly euphoric and then some event happened and then you see the correction. So I think these are all excuses you get it. But if I have to conclude, I think we remain very constructive on this space. But risk appetite as well as liquidity indicators for pharma sector as a whole is again inching up. So we remain very, very constructive from a longer term perspective.
Sure. The last time we were chatting with you, Sandeep, and I recall categorically that you were saying that, suggest relooking at stocks from within the energy space, capital goods, realty, as well as textile. The other pocket also is realty, and given its high beta nature, at least in the last 10 days of the accelerated market fall, we've seen, and it's, I guess, predictable as well, a serious amount of profit taking in some of the realty names as well. But would you say that the long-term fundamentals still look intact for realty? And would you be buying these dips in the market right now when it comes to real estate stocks?
So when we talked about that capex cycle, India capex cycle is in our favor and realty is also a derivative of this cycle. So we remain constructive on this sector also, but we have seen last 1 year the easy phase of money which was made in the realty sector, that is largely over. But from a longer term perspective, I think our data points has not peaked out. So I don't think one should be too much worried about. Obviously, given the nature of this sector, the beta is significantly high. So you will see sharp reaction like day before yesterday collapse and yesterday they recovered also equally sharply. So I think from a larger perspective, if I have to talk about next 2 years or 3 years perspective, as a house, we remain quite constructive and we still own some of these names in our portfolio.
I want to go back to banks. Now, banks have come on the right side of the pandemic. They've raised capital, growth is back, NPA cycle has reversed, and a new capex cycle is staring at us. Yet banks have been underperforming, and they've underperformed for quite a while now. First there was concerns about NPAs, what will happen to retail delinquencies, but thankfully nothing of that sort has happened. If at all, banks have been the surprise, winners. If I look at the last 2 quarter numbers, yet banks have not been the massive outperformers in this market. So is there something which markets are worried about, which we are not able to figure out? Why is that?
So very simple answer. FI banking space or the sector weightage is obviously in the Nifty is very, very high. And it is grossly over-owned sector, not only by domestic, but by the FIs in particular. And if you look at in last 1 month, when we talked about that big cycle is inching up and we have seen sudden spikes in the dollar index, all as a combination, whatever we have seen in last 1.5 months was not very consumable from the, was not very constructive from the FIS point of view. And that's the reason we have seen extraordinary profit booking happening. And again, another phenomena is also about from the FI perspective, their calendar year is December. So their bonuses and other things linked with the year end. That's the reason we have seen extraordinary selling pressure happening in the last 1.5 months, particularly in the banking and the large caps name, which all the stocks or sector which is grossly overowned by the FIs, we have seen actually some amount of selling there. But I believe that is also in a very fang end of getting exhaustion. Okay, because we are now month is over, okay, and we are in the December month. Traditionally, from the seasonality factor point of view, December is also relatively more favorably for the equities globally, and the volumes will obviously on the lower side. So I think the extraordinary selling pressure which we have seen. So if you have to talk about like Quant Fear Index, second highest position or maybe third highest in last many years, the extraordinary short positions we are also seeing in the banking names. Okay, so from this background, I think from the current level, we think it's a good opportunity to make money in these names because fear is very, very high and people are just giving up.
You like textile stocks. Why is that? I mean, textile is like a low margin, highly volatile business which is highly dependent on global trends. Why do you like textile stocks?
I think this China plus theme which is playing out quite well, and India is quite well poised for that space. Okay, and given the interest from the government also, it has generated one of the highest amount of job opportunities point of view. I think our call is much more global in nature. Okay, we have seen China plus factor playing out. It moves to Vietnam and Bangladesh has also have their own challenges. So I think India has one a large capacity, good amount of raw material. I think this space, and we were very being a leadership status in this industry for a long period of time, which we have lost in last 10 years or so. I think it's coming back. So our theme is more of a macro perspective rather than just saying that India or it's a textile as a theme is given the global background, we see money coming towards this space, and we have seen good amount of interest already building up. So both from the risk appetite point of view as well equity point of view, we have seen good amount of risk appetite rising, and money flow is also inching up within the textile space.
Sandeep Tandon, very recently you spoke about how in the last 1 year, the Quant Infrastructure Fund gave 119% return and outperformed the benchmark by what? More than 60%. Can I ask you, going forward, what is your strategy to make sure that this outperformance stays?
The first point is that we have been talking about the infra as a theme for quite a long time, maybe for a year now, okay, and it's just catching up. Capital goods as a cycle or infra as a theme will remain very, very constructive. I don't know about next 5-10 years, but next 3-4 years perspective that visibility is there, and it is grossly underowned. The space has underperformed for a lot period of time. So I think the opportunity is there, and the supply side factor is very, very limited. Okay, the pressure which let's say you're seeing in banking, you will not see in the infra name. We the way we manage our money, our strategy is not about buy and hold and sit for a longer term perspective, because we believe we are in a very dynamic world, and global market dynamics keeps on changing and keeps on evolving. So our style of money management is also very dynamic. Then we work through our own framework where we give only 1/3 weightage to the valuation analytics, which is based on the cash flow, but we give 2/3 weightage to other components like global liquidity, global risk appetite. So we combine, very simple terms we call fundamental Atma, liquidity, the prana, and sentiment, the Maya. Capture all three things: qualitative, quantitative, and behavior. So if you combine it, I think that's the reason we are able to outperform the market. And I think the framework has worked quite well, and it will continue. We expect that it should continue to outperform the market.
And one question I wanted to ask you, when we talk about the return of the cyclicals, and you've spoken about the rotation in the past, deep value stocks, going back to the basics, what happens to this entire conversation then that we're seeing as far as the platform stocks go, the new age companies go? At one end, some people say that maybe they're going to be dominating the Nifty and the Sensex going forward. Would love to get your views. These are loss making, but shouldn't one bet on the future now?
See, if you really look at from the business point of view, yes, they have definitely have very, very interesting business model, and that's what the future is all about. But we also have to keep in mind what valuation we are buying these names. Okay, when we talked about that, we have seen the perception indicator for growth stocks have peaked out, which and within growth, I just want to exclude the EV or renewable space. That's we have not seen any spike or any meaningful spike to say that they have peaked out. But if you really look at the larger perspective, and you're getting a signs of a perception indicator peaking out, and then you simultaneously see a euphoria happening in the domestic market, some of the very recent listing, and I think everybody Even the people who are mature investor for last 20, 30 years are getting sucked in, it's very, very difficult to hold, that we are unable to participate and left out feeling is very high. That's the reason we are saying that, that it can even last for a few more months. Okay, but end of the day, it's all about cash flow, whether you want to give this sort of valuation. I personally feel when global volatility will remain relatively high, this is the one phenomena which I think cycle has played out, and it's played out quite well. But if you expect we will be going to participate in these names, the answer is clearly no, because we believe other opportunities in the market is equally meaningful and with a lower risk. So we would like to look for optimized return for our investor in terms of risk adjusted returns, and these names will not qualify in our model portfolio.
Sandeep, always good to have you on the show and get in all the insight.
Thanks.